So here's the thing. To be a successful venture capitalist, in my opinion, and I think I might have mentioned this last time. In order to be a successful venture capitalist, I feel like you really need to do three things really well. Well, you need to do two of three things really well. You need to be able to source deals. You need to be able to pick winners and do due diligence. And you need to be able to raise money for your fund, right? Because in venture capitalists, we invest other people's money. We invest our own money as well, but we're also investing other people's money because there aren't very many people that have hundreds of millions of dollars that they're willing to plow into very risky startups, right? So you need to be able to do those three things, or two of those three things really well to be a great venture capitalist. And what we're going to focus on with this competition is the two: deal sourcing and doing due diligence. And so tonight we're going to talk about deal sourcing. Now, the thing with deal sourcing is that it's not just enough to know that there's a company out there that you think will be successful. You actually, to be a good VC, you have to know about that company and you have to convince that company to let you invest. I think a lot about, an example of this was a friend of mine. He was really big into music. And at the time he knew that Spotify had just launched, and like, he thought it was amazing. It was going to be like this game changer in the music space. Like, he knew very early on that like Spotify was going to be a massive home run, right? But the problem was he had no connections to the company. He had no idea, like he had no access to the deal, right? And so that brings us to that big question of like, you got to find the deal. You got to know the next Spotify, and then you have to be able to convince the entrepreneur to take your money. So let's dive in. So tonight we're going to talk about thematic deal sourcing and opportunistic deal sourcing. We might do a little bit of a group exercise, and then we'll go through just some tips and tricks of how to do that as part of it. We'll do some deadlines, and then we'll just have a bunch of rooms open with UGF associates to answer questions as you have any. All right. So thematic or opportunistic? Another way to think about thematic or opportunistic is hunting versus farming for deals. Hunting for deals is where you come up with a theme that you want to invest in or a hypothesis. I think that in the future, people are going to meet together in virtual reality, right? That's what I think the future looks like. So that's my theme. And now I want to go and I want to look for companies that match my vision of what the future is going to look like, right? And are doing things to make, virtual reality meetings a thing, right? Or it could be any number of different things in terms of how you view the future. It could be, I think that grocery delivery needs to be done in like 10 minutes or less, right? 15 minutes or less. So maybe you go hunt for those types of deals, whatever it might be. That's more thematic, right? Come up with a theme. The other is, and that's why it's called hunting, right? Because you're out there and you're looking for that one specific deal that meets kind of all of your criteria. And when you see it, you pull the trigger and you make an investment in that one deal. The other is more opportunistic or farming. And the way that works is, rather than being really focused on a specific theme, you actually do a lot of preparation work to cultivate lots of relationships and opportunities. And as those opportunities come through the door, then you select which ones you think are going to be successful. Now, the challenge with that is that farming takes a lot of time and a lot of work, right? But the flip side, it can be incredibly fruitful. So with that as a little bit of context, let's talk about the fund Sequoia. how many of you, and if you guys can turn on your cameras, that'd be awesome. Allow us to have a little bit more interaction. But how many of you are familiar with the firm Sequoia? How many of you know them? Got one hand. All right. So not a lot of you have heard of the firm Sequoia. How about Robinhood, Apple, Google, WhatsApp, Yahoo, Instagram, EA Sports, Bird, LinkedIn, Dropbox? You guys know these brands? All right. So Sequoia was like one of the earliest investors in all of these companies, plus a whole lot more. I think when Instagram was acquired by Facebook for like $20+ billion, Sequoia owned like a third of that business that they bought for like, I don't know, like $5 to $10 million. So you can do the math on that return. Sequoia is like by far like the best of the best venture funds out there, like just consistent year after year after year, really good returns spanning back like 40 years, right? They're a really old firm. There are other firms that may have better returns in any given like vintage or any given year, but I don't think any can claim that they can that they've been able to post that strong of returns over that long of a time period in the venture space. So when you think about that, what type of sourcing strategy do you think Sequoia has? I mean, they are the best of the best. Do you think like they spend a lot of, they need to spend a lot of time hunting around for deals in the forest? Or do you think their door swings open or swings in with deals coming to them? What do you guys think? Throw out some comments in the chat, or raise your hand and I'll pick on you to say something. Any thoughts? Opportunistic at this point, but probably started with thematic based on their ideas about the future. Opportunistic. Okay, so here's a question. Which strategy do you think generates the best returns? Opportunistic or thematic? Okay, why? Why thematic? Somebody said thematic. Got a couple thematics. Why? Oh, I want you. Let's see. Alex, Justin, tell us why you think thematic. Are you there? Can you turn off your come off mute and tell us? I'm trying to find his name. Or how about Peyton? Everybody's shy.
For me, I feel like it would be like I said, I think it would be thematic because you're kind of out there looking for the deal, whereas other people who might be, I guess, coming to you for that opportunity, they might not. I guess I might need it more. Whereas like those good opportunities, you might have to look for more than those that kind of just come to you.
Okay. All right. I like that line of thinking. Howie, you got a rebuttal? Or anybody have a different opinion?
Go for it. Justin here. You want to go first, Justin?
Okay, yeah, I can go first. I think with thematic, you're looking for something specific. You believe in something. You have an inkling of an idea that something's going to be great. So you're looking for a company that matches that, a company that's doing that. So not only are you searching for something that you believe is going to be great, you've probably done research on what's going to be great. Maybe not that company, but maybe products in that area. Let's say, specifically healthcare. We've seen healthcare grow, immeasurably. Walmart is on the verge of starting their own healthcare industry built into Walmart. So we're going to start seeing Walmart actually launching pop-ups in their parking lots, little buildings where you can actually go and get a physical or get tested for certain things and start doing more pharmaceuticals because there's a lot of money to be made with grocery being a sunk cost. So I think with thematic, you recognize an area of growth. So therefore, you've already got a win in the bag. So all you need to do is find a company that recognizes that as well, that's capitalizing on it and doing it better than anyone else.
Yep. Okay. Howie, let's hear your rebuttal.
All right. So I think in my view, business is all about relationships. So like if you've established yourself as someone who's good and someone who does things, then people like you said with the Spotify, he wanted to get Spotify, he knew it would be big, but he didn't know how to get in there. And so if you've established yourself as someone who has good relationships and who, if you establish yourself with lots of different people that you have good relationships, then when they have those great ideas, they can come to you and say, I have this great idea. And then that gives you the opportunity to say what ideas you will or you won't invest in. If people are giving you the options, then they're the beggars now, and you are the chooser instead of vice versa. Instead of you saying, hey, I really want to invest in your company, will you please let me? People say, hey, can you please invest in my company? And you can say either yes or no, and you can determine much more close which companies your money's going to go into. But I think altogether, you're still going to want to be able to branch out into those kind of like crazy new themes, those crazy new opportunities. I think maybe a balance might be best between the two, but I would say maybe 60-40, and I would favor opportunistic. That's my theory, at least.
Fair enough. Awesome. So I think here's the punchline. I think most funds do a little bit of both, right? I think that you can make a lot of money with both strategies. You have limited time, so you can spend that really digging in and going after very specific deals, or you can kind of go out and farm, right? Where you build relationships and network, and you wait, in some cases, years for those things to materialize into real deals. And I'm familiar, I know, having done this for the last almost 15 years now, both strategies can work and result in really great deals. That said, Sequoia, you would think that they could be just opportunistic. They have this incredible brand, they have incredible networks, right? They've backed all these companies. Deals come to them all the time. But that said, they don't fund most of those deals. Most of the deals that they go after are ones where they use a more thematic approach. So they will identify a major theme. They will then go and meet with all the different companies. They will identify which one they think is the best. And then they will use their brand, their clout, their network to convince that entrepreneur to let them in and invest, right? So if they, Spotify, for example, they could have gone to Spotify and because of who they are, could have gotten their foot in the door and done that deal, right? So there's definitely a little bit of mix of doing both. But generally the best firms use a more thematic approach, generally speaking, when they're approaching venture investing. So how do you do a thematic approach? Well, there are these big things called Lumascapes that can be really interesting and helpful. I just like this diagram from a perspective of, hey, I want to look, let's say you wanted to invest into digital agencies, right? Which most venture funds probably wouldn't invest in a digital agency, but for just the sake of argument, you could map out this whole value chain, right? So in this case, this is different types of digital agencies. You have a creative agency, you have digital agency, you have media agency, you have data and marketing services that plug in to the different agencies, you have public relations, and you have all of these different little companies that play within this overall ecosystem. right? And so you could say, hey, you know, I think that there's a really interesting opportunity around marketing and data services, right? And I want to map out all of the different companies that play in that space. And then you want to be thinking about, like, what are the things that will allow one company to be successful versus another? And identify the one that you think is the most compelling, and then go after that one company. By the way, these things can get really big. So this is the marketing technology, also often referred to as MarTech, landscape for 2017, right? And you have all of these different companies that are each doing a different part of the overall value chain, and how they all interact. So if you want to take this approach, one of the things that I recommend is you actually create your own kind of mini Lumascape, or your own value chain, right? Where you say, okay, I think, because going back to my earlier example, let's say I think that meetings in virtual reality is going to be a thing. Where do I invest? Because there are a lot of different pieces. Do I invest in people that make VR headsets? Do I invest in companies that make software that allows you to all meet in a virtual world? Do I meet in companies that that are building the operating system? Do I invest in companies that are making the marketplace where you would actually download that application? Do I invest in companies that are making tools, such as, like, maybe we need to come up with an avatar, right? And maybe I invest in a company that makes custom avatars, right? Like, the list could go on. So what you want to, ideally, what you want to do is kind of sit down and map out, like, what does this value chain look like? At each step, where is value added to get to the end result? And then start looking at the different companies and the different types of businesses that operate in those different areas. So for example, the headset, you may not want to invest there because it's hardware. It's typically a low margin. There's new headsets coming out all the time, so it's a competitive space, right? You might look at that and say, that's not a compelling place to invest. I want to invest more on the software side of things, right? And I want to invest in that virtual conference room type technology, right? Or whatever it might be. And then you start digging in and analyzing all the businesses that fit within that criteria. And hopefully selecting the one that you think is going to be the most successful. Now, I'll tell you that in order to do, like, you can approach this competition from either a thematic deal sourcing perspective or an opportunistic one. Thematic is going to be the best, but I will tell you right now, it's going to be the hardest, because you might find the very best deal within a space, but you have to meet one of the main criteria of this competition, which is getting in touch with that CEO or founder and convincing them to share some data with you for the competition, right? And that becomes the signal, if you will, that says you would have gotten access to that deal, right? If you were actually making an investment. That's how we're qualifying that part of the competition. So, you know, a lot of the companies that are going to be the most successful may be the hardest ones to get in touch with, right? But if you can pull it off, this is by far, you're going to find much stronger companies, broadly speaking. So how to find your themes. Look at your own experience. Where are gaps in your experience, right? Like where are things, like, where do you wish things would be better or easier or cheaper, right? Anytime there's a gap or a market inefficiency, there's an opportunity to start a business and run it. When I've done a lot of consulting work internationally, so I've worked across Africa, Latin America, and the Caribbean. And a lot of what I've done is go into markets, analyze those markets, look for areas where there are inefficiencies. So like, I'll look at, like, I'll go to the market and I'll just start buying stuff in the market, or at least asking prices on stuff. And if anything pops out as being way too expensive for what it should cost, like I'll zero in on that as a market inefficiency. And then we will work to launch a business that brings the price down, because I'll know, like, as Jeff Bezos says, like, your margin is my opportunity, right? So identifying kind of those issues and bringing more efficiency. So looking for gaps in a market. Another question you can look at is, what is software people use but they hate? Like software they have to use, they must use. So this is how our investment in Instructure came about. So some of you probably are familiar with Canvas, the learning management system that's produced by Instructure. So the story behind that was Josh Coates, who was the CEO for a long time. He was teaching a class at BYU in the computer science department that was like, it was like how to start a business for computer science students. And at the very end of the course, his assignment was to go find a piece of software that everybody has to use, but they hate. Because usually that's a good place. It's a good question to ask when you're trying to figure out what kind of software you should build. And 2 students said, you know what? Everybody has to use learning management software, but everybody hates it. It's not good. Everybody just hates it. And so they came to Josh Coates and they were like, hey, we know that you're a successful entrepreneur. You've got money. We've got this idea. What, we would like to do it and we'd like you to invest. And he said, I'm not going to invest. But if you guys are really serious about this, then I'll tell you what, you go and you meet with 50 CTOs or CIOs at different universities. You talk to them and come back to me. And if you come back to me and can demonstrate that this is a real need, then I'll consider investing. So the 2 co-founders got in their car that had no AC, little beater vehicle, and they spent the entire summer driving up and down and side to side the US, meeting with CTOs and CIOs of major universities. They ended up meeting with 35 of them and came back to Josh Coates with a whole bunch of notes around how much every single CTO and CIO hated the LMS and wanted something better. And when Josh Coates went through it all and realized how big of a pain point it was, he ended up investing in the company. And then later on took over as CEO, and now they're worth, a couple $2 billion. Maybe more. I haven't checked their recent share price, but very successful outcome. So that could be another good question. What is some software or products that you have to use, but you hate? And then lastly, like, what does the future look like, right? Are we, when I was in school, I thought a lot about how at some point, this was before Redbox, and we still just kind of had Blockbuster, but I knew that like we are going to be streaming video, right? Netflix existed, but it was not streaming video. At that point, Netflix was only shipping DVDs. But I knew that it was coming, right? Because I knew the internet bandwidth speeds would improve, and eventually like streaming video would be a thing. So think about like, what does the future look like? So if you're me back then, you could be thinking about, hey, I want to be investing in companies that are going to be streaming video, or maybe I'm investing in companies that are providing better bandwidth, internet connections and internet speed, right? Or maybe I invest in companies that figure out how to send video over low bandwidths or whatever, right? What have you. So like YouTube and Netflix and others. Some really good resources, like you can read different blogs like A16Z, that's Andreessen Horowitz. They have a great blog and podcast. Stratechery, TribeCap, they do a lot of blogging that's really interesting. avc.com. What you're looking for is where other VCs, because oftentimes VCs will publish like the themes that they're excited about. What are other VCs excited about, right? What are other VCs investing in? right? And so you can look at those as ways to give you an idea of like, and kind of leverage what they're seeing and what they're excited about to kind of inform your own opinion. All right, so an opportunity. So I'll just pause there for a sec. Any questions on thematic deal sourcing? Does it make sense? Kind of come up with a strategy, do your research, and then go out and hunt.
I have a question.
Yeah.
What does University Growth Fund center their theme on?
So we are not a thematic investment firm. We are an opportunistic fund. And the reason for that is because we don't lead rounds. We're never going to be the largest or single investor in a deal. And so we occasionally we will use a little bit more of a thematic approach, but generally we have kind of our networks and we're constantly cultivating those networks to drive deal flow in. And then we try to do a really good job picking deals.
Okay, that makes sense. Thanks. So it's like the case competition for University Growth Fund, like another form of building those networks and finding more people?
I mean, potentially, like we've never funded a deal that's been identified through the conference, or for the competition, but certainly there are some really interesting investment ideas that have come through it. We do it because we want to impact more students more than anything else and expose more students to the world of venture capital. And, you know, if they're interested, then also it becomes a source of talent into our intern program. But first and foremost, it's about providing this opportunity to more students. So,
Super interesting. Well, we appreciate it. Thanks.
yeah. All right. Any other questions?
Does investing thematically, do they often get into the market or get in with these companies a lot earlier than if they're using the opportunistic approach, or not necessarily?
Not necessarily. I would say on balance, they probably get in later because they're looking for something very specific. And if you're brand new, nobody knows about you, it's hard to find you. And you may not have fully fleshed things out to a level that it needs to be at for an investor to be able to say, yes, you're the one that we've been looking for, right? That said, another thematic approach is through, and this is not really related to the competition, but just for your information, a lot of venture funds will bring on like an entrepreneur in residence or a venture partner. And their job is to basically start a company with a thematic approach. And then the fund will fund that company, right? So they bring in a great entrepreneur and that entrepreneur becomes entrepreneur in residence. They leverage their background connections. They get a little bit of money from the venture fund until they can find the business that they want to start. And then when they start it, the venture fund invests and gives them the capital that they need to start, right? So that could be another way that venture funds will quote unquote source an investment using a thematic approach. All right, let's talk about the opportunistic approach, which is more what we do. And I will tell you, like I said earlier, is the easier of the two for you all. So in this approach, you're looking for great deals generally, rather than looking for the best deal in a specific industry. It's very network driven, right? So I've sourced a lot of deals through my network that came from relationships that I've spent 15 years developing. In one case, I worked with this guy for probably 7 years. It's a good friend of mine. 7 years before it turned into a deal, until like that relationship yielded an investment that we could do. We made that investment, and as of right now, it's the best performing investment in the portfolio, right? So, and we'll return somewhere in the range of, I don't know, like 15x. So, but it takes time, right? So that's a good outcome, but it takes time to build those networks. That said, That said, in your case, you can step into some really compelling networks right away. And you can do that through the equity crowdfunding platforms, right? Because you essentially are able to get in front of a whole bunch of deals through one relationship, and that relationship only requires you to go to a website and start looking at deals. That said, you still need to refine your approach to some degree. And the reason for that is because it's like apples and oranges. If you go to the produce aisle and you say, I just want to invest in the best piece of produce out here, you're going to spend a lot of time sifting through a lot of produce, right? What you want to do is you want to say, okay, I want to invest, I want to buy the very best apple, right? That's out there, the very best orange. And so you can kind of narrow it down and you can really hone in and look at just the oranges and figure out which, and as you look at more and more oranges, you get better and better at finding which ones are going to be the best. You refine that ability, and it allows you to find the very best orange and buy it, and right, or in our case, invest in it. So that's why I recommend like refine what you want to look at a little bit, so that you don't spin your wheels looking at a zillion things and not being able to really identify which one is going to be the best. So your group might say, you know what, we want to just look at enterprise software deals. Or we think there's a really interesting opportunity around self-driving cars. Or we think there's a really interesting opportunity in consumer tech, right? Like we all love consumer type products. So we want to invest in a consumer products business, right? Whatever. And so like, we want to just look at as many consumer products businesses as we can and find the best one there. So whatever it is, as a team, I would recommend blending a little bit of the thematic with the opportunistic, hone in on like, what's your apple, right? That you're going to go after, what's your orange, and then start sifting through lots and lots of deals, either through the equity crowdfunding platforms or through your network and, you know, reading news articles and so on and so forth for companies that have raised money, especially if they've raised some seed money. The earlier stage the company is, the more likely it is that you'll be able to get in touch with the CEO and get information from them. All right, so we're going to, I'm going to hit on a couple things here, and then we're going to go and we're going to pull up WeFunder, and I'm just going to sift through a bunch of deals, and I'm going to just talk out loud what's going on in my brain as I review those deals, so that you guys can see like a little bit of how I would start screening deals, if that makes sense, and what things I think are important or not important. But generally, these are the things I look for. So does the company have a unique product or business model? Are they differentiated? Do they have some sort of competitive advantage? Or will they be able to build one over time, right? So if you're a marketplace, day one, you have zero competitive advantage. But if you can build it in day, you know, whatever that is, into the future, you can build an incredible competitive advantage. So, you know, thinking through that, do they have one or not? Will they have one? Can they actually get far enough along to build one? Those types of questions are things you should be asking. Do they operate in a really big market? Now, most businesses will probably change their business model or business plan several times before they find the right one. That's okay, as long as the space where you're investing is really big, because it gives you a lot of room to navigate, move around until you find the right business model. If you operate in a really small market, there might only be one business model that really works in that market. And if you can't find it, you'll probably fail, right? So big markets. Now, the other thing, like we talked about last time, is big markets also matter, because if you want to build a big business, you need to do it in a big market, right? And then the last one is, do they have a killer team? Are they experienced? Do they have passionate? Do they have team market fit? Do they have that earned secret that I talked about, right? So if I'm investing in a enterprise software business, do I want to invest in a team that's still in college? that has no experience in the enterprise, right? Probably not. I probably want to invest in entrepreneurs that have worked in enterprise, that have built enterprise grade software products. They know what it's going to take. They have connections and relationships in enterprise software and in the area where they want to sell, the specific vertical. They have that earned secret, right? Because they've spent so much of their career bashing their head against the wall because of some pain point, and now they're going to build a product that solves that pain point. I met with a company today at the conference called Guide CX. They're doing some really interesting things. That idea for what they do is they help companies onboard customers and to make sure that the customer fully engages with the product. And the reason they came up with the idea was because at their prior company, DealerSocket, that was one of their biggest challenges, was getting customers to get onboarded and fully utilize the product. And if they didn't get onboarded and fully use the product, they would leave after a year because they just weren't using it. But those that came on and fully engaged tend to stay for years and years and years and years. And so that's what Guide CX does. And the reason they started it was because the team had earned the secret, right? Like they had personally suffered that pain point and they had figured out how to solve it at their prior business. And they wanted to take that and sell it to all the other companies that felt that same pain point. So you have like team market fit, which goes along with that, right? If I want to invest in a consumer products company like Facebook, right? Am I going to invest in a bunch of old enterprise software people? Probably not. I'm going to invest in somebody young that knows what younger generations want, right? So kind of does the team fit with the market? And of course, like, are they passionate? Are they driven? Or are they just mercenaries, right? Are they just there to make a lot of money? Or do they really like care about solving their pain point? All right, so just some other things to look for. I think from just screening, these are like the big top 3. Once you want to dig in a little bit more, these are other questions I like to ask myself. So like, can it scale super fast, right? If I have to build a new factory, every time I want to sell another product, that's not going to scale very fast. But if all I have to do is sell another subscription to my software, that can scale really, really quickly. Do they have unique access or partners, right? So sometimes that can be helpful because if they have a unique partner, they have unique access to a market, then that can help them accelerate things a lot faster. So a good example of that would be, there's so many good ones. I'm trying to think of, so we're an investor in a company called Mosel. Mosel does device management for Apple products, primarily in education. So if you go to an elementary school and they give you an iPad, Mosel is the software on the iPad that to manage it, to make sure that the kids don't go off onto places they shouldn't, that they don't go like playing games on it when they should be doing class, like all kinds of things like that. They have software that allows the teacher to like push quizzes and interactive things to those iPads, those kinds of things. That's what MDM or device management does. They have a unique partnership with Apple because they only do this for Apple products. And because of that, Apple has given them unique access to the underlying code so that they're able to embed a lot more functionality and controls into the hardware and software that runs on iPads and computers and so forth. And then Apple also has made them like a preferred partner, and there are only a couple preferred partners. So when large companies and schools and so on and so forth come to Apple and say, hey, we need a device management solution, Apple says you should use Mosel. That is a unique partner and unique access, right? They operate in a huge potential market. So back here, I said they operate in a big market. Maybe it's not a big market yet. Maybe it's a huge potential market. So maybe they have some sort of unfair advantage over competitors, like network effects. And can they create liquidity in the next 5 to 10 years, be it either getting acquired or going public? Is this the type of business that will either scale to be big enough that it could be a publicly traded company, or can it grow big enough to be of strategic value to another buyer, either because they're building incredible technology or they've got access to a consumer that larger brands want access to, or whatever it might be? Can they create value for an acquirer to be interested in buying them? All right, so let's quickly do a little exercise together and let's look at some deals. All right, so shoot, no, I don't want to discuss. I just want, there we go. All right, so let's look at some deals here. Just scroll down here a little bit. Raising now, closing soon, closing in 4 hours. Just kind of skimming through here really quick. See what's top of the list. See here, this is kind of cool. Like they already will like bucket it into different things, right? I want to invest in moonshot ideas like flying cars. I want to invest in companies that came out of Y Combinator, which is arguably the best startup accelerator in the world. I want to invest in alcohol. I want to invest in like Main Street businesses, biotech, entertainment, right? Long line of different things. So why don't we do marketplaces? Let's see what pulls up for marketplaces. Actually, you know what? I'm going to go back. And I want to look at these deals that are closing soon, just because we know that they're closing soon. They've probably raised some money, right? All right. World's first community-powered online ordering and food delivery. So founded by award-winning chef, just launched, leadership heavyweights. So they got some people from Apple, Microsoft. That's interesting. $160 billion global market. That seems a little big, maybe. It depends on how they're defining that. Innovative business model. Okay, so if we look at our founder here, serial entrepreneur. So, okay, so usually that means that he's built multiple businesses. Let's see, he was part of joint Microsoft Accenture team. Wow, that generated $2.8 billion in 2019, although that was in 2000, so there's a little bit of disconnect there. So part of the thesis here is that tech companies have raided the space and taken restaurants, customers, and profits, but they believe that technology should be used to serve restaurants instead of restaurants serving tech companies. Dine Direct gives restaurants the tech and community they need to win back their customers and money. Okay, this sounds actually a little bit like our investment in Toast, the point of sale company. So I know a little bit about this space. All right, first takeout and delivery company built to be owned by diners. We're on a mission to take down the titans of Silicon Valley. Okay, big ambitious goal, and give restaurants and their guests a seat at the table. Local customer seafood. Yeah, so here's what they're saying. Here's the problem, right? And this is very similar to what I described with my work in Africa, right? The consumer pays $53 to get a burger and onion rings, and they're probably cold by the time they show up. The food app company gets $28 of that between delivery fees and taxes and add-on fees and a tip and all that other stuff, and the restaurant only gets 25 bucks. So it looks like what they're trying to do is we're going to try and cut out this like middleman and just connect the restaurant directly to the local consumer. And so the restaurant would keep, well, the local customer would pay closer to $25 and the restaurant would keep all of that. All right, so that's an interesting concept. Curious how they're going to do that. So they take a smaller fee to process the order, but they probably rely on the restaurant to do the actual serving. It's interesting if you can figure out a way to make that easy on the restaurants to actually do the delivery, because that ends up being a pretty big challenge. Traction. So this is number of signups. Okay, so that's interesting. So they got 50 customers. So, I mean, it's still really early and really small, but, you know, people are clearly buying it. So that's interesting. All right. I mean, those are kind of the big bullet points there that we've got. A bunch of updates, details. Oh, okay, here's your financials. So $608 of revenue, and they burned 143,000. All right, we got 50 grand in cash on hand, and they've so far raised 284,000. So okay, interesting. So if we think about this, pros. Let's talk about it. So the CEO looks like he has kind of decent background. I would want to look him up on LinkedIn and get a better feel for like more of his experience. But sounds like maybe he's done some interesting things, and this isn't his first rodeo. I wish there's a little bit more about him. And there's nothing that really ties him to restaurants. So already I'm kind of wondering, like, do they have the right team here? Julie, the certified coach in impact and responsible business. All right. And then a hospitality consultant, owned a restaurant. Okay, so that's interesting. So this guy actually probably has some restaurateur of the year and chef of the year. So this guy actually probably like has lived and felt this pain point firsthand. So that guy's pretty interesting. And they got a bunch of other people. All right. Concept wise, I got a bunch of questions, but generally like they're solving a pain point. I don't know if I see any sort of real competitive advantage here though. Like it's different from like the incumbents like DoorDash, but there have been a lot of other companies that have tried at this. There is a company though that's doing interesting things around similarly to what these guys are proposing, but they do it. It's a company called Slice, and they do it specifically in the pizza space. So what they found is that something like 90% of orders for pizza happen offline. Like somebody calls up the pizza place, and this is for small chains or independents and very, very small chains. This is not for Domino's and Pizza Hut. So most of the orders come through the phone. And what Slice does is they help these companies provide all of the same tech stack that like Domino's has when you order through the app or through their website. So that's what Slice does. And they have built a phenomenal business doing that. All right, so that's Dine Direct. Could be interesting, you know, some pros and cons, but I'd really want to dig in deeper on that competitive advantage because it doesn't seem like there's one there. All right, let's talk about this one because you all are in school, so you all have some firsthand experience with education, right? We're disrupting higher education with higher education through Certifiable and regulated courses. Interesting. Okay, so some details here. So 11,000 users, 20,000 enrollments in Canadian insurance industry alone and growing. Interesting. Okay, so that's some real traction. Sales top 400,000. Okay, so they've got like, looking like they've got some level of product market fit. People are actually willing to pay for their service. Expanding independent external, let's see. My guess is, and $250 billion market. I'd want to dig in on that and how they actually define it, but it's a really big market, if nothing else. Let's see, founder CEO of PNC Learning, one of Canada's leading independent providers. Okay, good. So he's got some real background there. I like that. Having employ people from college, the challenging to get them predictable in the skills the job requires and not just theory. Hey, I like that. The fast changing business world and skills they require today and tomorrow necessitates ongoing upskill and reskill of staff without leaving them with mountains of debt. All right. So like, not to get on my soapbox, but I think this is interesting concept already, right? Here's the dirty secret about your college education. Hate to tell you this. You're going to spend a lot of time and a lot of money learning things that you will never apply ever again in your life. And when you get into the job field, guess what you're going to have to do your very first day? You're going to have to go through a whole new level of training so that you can actually do the job you were hired for, because they probably didn't, you didn't get trained on how to do sales or how to build a product or how to manage people or all of those different things that go into doing your day job. So that's what he's saying here is like, I employ people from college and university, but it's hard to get them productive because then I have to spend all this time teaching them on the job how to do their job, as opposed to just the theory they learn in college classes. And then part two of this is that the world is moving so quickly that your college degree is not going to be enough to keep you up to date and relevant. You're going to have to get ongoing education throughout the rest of your life to be competitive in the workforce. So looks like that's kind of what they're doing is they are building a certification education program and platform that helps students prove like, yes, I can do this job. I don't need to go necessarily and get a 4-year education if what you care about is that I can do the job day one, right? And that's looks like what they're doing. And they're making the argument, here's the pain point, like people get saddled with tons and tons of student debt. There's a skills gap because when they graduate, they can't do the work day one. Mobility. Okay, so mobility is no longer an issue because people can take courses online anywhere in the world. And then the other challenge is that most online education platforms are unregulated and unrecognized by industry. So that's one of the challenges, right? Like if I do an online course, did I actually do it? Did I prove competency in that topic? Like, am I actually able to do the job now? I mean, the good thing about universities is that when you graduate with a degree, employers know that you're smart enough to get in, you're smart enough to do well enough to graduate, you work hard, you learn relatively quickly, right? Like there's a lot of intangibles there. And maybe you understand kind of the basics of what your industry requires. Like if you're going to do investment banking, you took a bunch of finance classes, so you know what an income statement is, right? If you do computer science, like you've done a bunch of coding, even if the coding that you did wasn't necessarily super relevant to the coding that they want you to do, at least like you have some exposure to it. The downside is that you still then have to go and get caught up with the specifics of what a company needs to do. All right, so let's see, they've got what they're doing. They're providing these certified courses. Here's their traction since launch. What differentiates us? Here we go. Mandatory. Okay, so what they're saying is certain industries they mandate that you get continuing education and that you prove that through continuing education certificates. So they're saying they benefit because they can tap into those. I don't know that that's really a competitive advantage because there are other companies that are doing the same thing as them. Curriculum development and partnerships with established educational institutions, maybe. Proprietary. Okay, this last one could actually be a real competitive advantage, but you'd want to dig in on who those major employers are. So proprietary courses, certification recognized by major employers. Here's the big thing. From my perspective, this only really works if employers agree that their certifications are worth anything, right? So this could be, but if they do, there could be a major thing. So today, even today, Tim Cook was on stage at Silicon Slopes, right? CEO of Apple. And he himself was like, look, you don't have to have a 4-year degree to work at Apple. If you can demonstrate that you can do the things we need you to do, you have the skill set, we will hire you, right? And he made a pretty strong point that like the relevancy of a university education over time may not be as strong as it once was. All right, so here's our competitive. We own the IP. Okay, that's good, but everybody's going to own their own IP. They have accreditation and regulatory approvals. So that's good, but that's probably like you have to have that even just to be, offering this product. Industry recognition. Okay, so some brand stuff. There might be something there. You don't want to dig in on that some more. Partnerships with existing higher ed institutions, high exclusivity. All right, so maybe I'd want to learn more about what that means, and doesn't matter, right? Because ultimately it's what employers want. All right, cool. I think this is it's interesting. Okay, so they claimed 0 in revenue, but they said that they had revenue. Okay, so they do have something. Maybe these financials are old. Yeah, so these are the financials as of last year. So they still haven't posted this year's. Okay. So if you think this business fits within your thing, like, okay, there's some things that I would look for, things that I like. I like what they're doing. I like their approach. Like thematically, I think they're, at least in my opinion, in my worldview of the future, like they are heading in the right direction. Offering a course and a certification is relatively scalable. They've got some good partnerships, it sounds like, but we'd want to dig in on that some more. They've got some nice product market fit in that like customers are paying them money for what they offer. So that's good. I'm a little bit worried about, and their team has experience doing these types of things. So it's not their first rodeo. They probably understand the pain points pretty well. It's a big market. So overall, I think this deal is fairly interesting. All right. Hopefully that was helpful. That's just how I would go about like screening through different deals. You're going to want to do that same thing with deal after deal after deal. Yeah, good point. MOOCs are offered at universities at MIT with certificates. It would make you worried, which is fair. Just to answer some quick questions. Yes, these training sessions are posted to the website after they're recorded. And if you have questions, the best is to email this email link and we will get back to you. VCCC@ugrowthfund.com. All right. Oops. Okay, hopefully, yeah, you can see my screen, right? All right, so some more rules for you. Here's what I want you guys to assume as you're going out looking at deals. You have a $50 million fund and you are in year 1 of a 10-year fund. So the way these funds, venture funds work is you have investors and those investors say, I'm going to commit to giving you $50 million over the next 10 years, right? So I'm going to take that money in the first like 3 years or so. I'm going to invest a lot of it into startups. I'm going to place my bets, right? And then as those companies grow and they need more money, I'm going to invest the rest of my money into those companies, especially the winners. We're going to assume that you're a seed stage fund. So you can't really go chasing down deals where like the company's worth $1 billion and doing 100 million in revenue. You need to be looking more for seed stage companies. And the idea is that you're going to target somewhere between 30 and 50 seed stage or early stage deals. So in other words, you're going to be writing checks somewhere in the like 1.5 to million to $1.5 million over the life of the company, right? So maybe this is 250, 500,000, maybe even $1 million. But keep that in mind as you're making your recommendation on how much you would invest in the company. And so you need to decide how much are you going to invest per deal, what your ownership targets are going to be, and what kind of reserves. So money you're going to set aside for follow-on investments. So let's say we decide to invest as a team into that company that does the certificates, right? Let's just say you would look at that and you could say, okay, how much should I invest? Well, I've got this $50 million fund. If my strategy is I want to spray and pray and invest in a lot of stuff, maybe that means I'm only going to invest in 50. I'm going to invest in 50 deals. I'm only going to invest $1 million per deal, right? And so maybe I'm going to invest like $250,000 to start, and I'm going to reserve $750,000 for follow-on investments because I know like it's going to take a long time, right? On the other hand, you could say, you know what? We're going to take a very concentrated approach. We're not going to spray and pray. We're going to just pick a few companies and be highly selective of which ones we invest in. And for those, maybe we write a bigger check. Maybe we write $1 million instead of $250,000 or $500,000. And we're going to reserve another $500,000 to $1 million for follow-on investments later on. Another thing you should be thinking about is if I invest $1 million in this company, or I invest $250,000 in this company, what does that buy the company in terms of traction and growth and outcomes? Because they will need to achieve certain milestones in order to convince the next investors to invest in the company. So you need to be thoughtful about, like, if I give them $1 million, does that give them enough capital to hire enough people, to drive enough sales, to build their brand, so that when they have spent all of that money, there's another investor there that can invest in the company and then take it to the next level? Or will they get to profitability, in which case they don't need to raise more money necessarily, and they can kind of like direct their own path? So that's another thing you should be thinking about in terms of how much you should invest per deal. And then ownership targets. So you want to keep that in mind too, because you should assume that only, depending on your strategy, 1 or 2 deals needs to return your entire fund here. So if you're doing 50 deals, that means you need to get like a 50x on your deal if you're going to only invest $1 million. On the other hand, if you're going to invest in 25 deals, then in that case, you can invest $2 million. Now you only need a 25x return to return your fund, right? But those should be roughly the things you should be thinking about in terms of ownership targets. All right. Question here. Can not investing the right amount in the money in the right company restrict possible growth as they're using those funds to grow? Yes. So that's part of what I'm saying here. What you don't want to do, big red flag, you never want to invest just enough that they get out on the lake, but not enough that they can't get across the lake and they're left sitting in the middle of the lake without a paddle. That's the worst. You're better off just not investing at all in that case. So make sure a company is properly capitalized. Or do you really want to invest in companies regardless of whether or not, let's see. I mean, I would expect you want to invest in companies where you have confidence that your money will help them grow. So otherwise, they don't need your money. All right. Again, this is the same list as last time. So bunch of the ones that I'd focus on would be Start Engine, WeFunder, and Republic. I think those 3 platforms have the best deal flow that you can get access to. I think Circle Up, AngelList are probably the next 2, although those might be a little bit harder to access because they're really made for accredited investors. Not that it matters for the sake of this competition, but they just have a little more, they can be a little more tricky to get access to those platforms. I threw ICOs on here because when we started the competition, there were a lot of ICOs, initial coin offerings in the Bitcoin space. I suppose if you really want, you can go that route, but I'll tell you right now that that'll be really tough to find an ICO that would perform well in this competition. All right, and as a reminder, as long as you can get reliable data, you can source from wherever you'd like. But there are no promises of confidentiality, and you do have to get reliable data from the company. You can't just like pick a company at random and say, hey, I want to invest in this random company because I think it's a cool company. Like you need to reach out and talk to the founder and be able to like show that you were able to get access to some data there. All right, next workshop's next week. We're going to dive into due diligence. You should already be hunting for your companies. Get your team signed up by the end of this week, October 15th, end of the day. And then your selection and description of 3 companies that you've identified, that's due October 22nd. So for that, all you have to do is find 3 companies you're excited about. Hopefully one of them you're going to start digging into from a due diligence perspective. But have 3 just in case you find something in due diligence that is a deal killer, right? Like the CEO like sexually harassed somebody and is being sued. Like that's probably a deal killer, not a deal you want to do. And you don't want to spend a ton of time doing due diligence and then find that out and have to go all the way back to the drawing board. So that's why I require you to have 3 companies that you submit. That's due October 22nd. Questions here. Let's see. What do you do if you're part of a funding round that doesn't properly fund a company in the short or long run? If the funding seemed like it was enough, but actually wasn't. Hey, that happens all the time. Then the companies need to go out and raise more money. And they can do that either from their inside investors, you, or they can try to find outside investors. Usually it's going to be really hard to find outside investors. And so usually inside investors are the ones to pony up the money to keep the company going. Where should we submit our team info? Rocky, do we have a form set up on the website for that?
No, not yet. I'll get that together so you can start submitting those companies.
Okay, and then we'll send that out in an email as well, that link. So it's really simple, just, names, email addresses. So actually, Rocky, let's throw in like LinkedIn links too. And we can use that to just verify that they're complying with the other rule around not having more than one person from another student-run fund.
Okay, sorry, you're talking about the team registration form. That is up on the website. But
that is on the registration. Okay.
But I have to add the LinkedIn question.
Great. Okay. No worries if you already filled it out. You don't need to fill it out again. Those of you that still need a team, let us know, and we're happy to place matchmaker and get you connected. All righty, any other questions? Well, Henry and Tony, there you go. Team of 2 right there. Boom, done. Make it happen. What other questions do people have?
I have a question. So I know you were mentioning a little bit about, ownership targets. Is
Yeah.
it always, are we always going to be aiming for equity, or are there times when we're aiming for like a percentage of revenue, profit, or revenue over like 15 years? Is there one or the other?
Yeah, so you're referring to like RBF or revenue-based financing. I would say for the sake of this, let's do either a convertible debt. So you can invest in like a convertible note or a safe round, or equity. And you would invest in those convertible notes because they're going to invest in equity. Part of the problem with RBF is that it's really hard to generate big enough returns to make the fund economics work.
I have a question as well.
Yeah.
So this coming Monday and Tuesday, we're meeting with the two CEOs of the companies that we're looking at. It's like, what are
Fantastic.
some things that we should ask them? Like currently, we're asking more about operations. We're meeting with their chief engineering officer as well. But like, what are some thoughts we should bring into them to like make them interested to talk with us again? Because once again, we're brand new, all three of us, and we're just trying to figure out what's going on.
It's good. I would ask them, how did they come up with their idea? What's their story? Right? Try to tease out like, do they really understand this space? Those kinds of questions. I would ask them questions about traction, right? Customers, revenue, anything that they're willing to share around that to get you an idea on that. I'd ask like why customers buy from them. What are the primary reasons? Like what pain points are they really solving? And when they lose customers, why do they lose customers? Right?
Okay.
I would talk to them about how do they acquire customers? What's their marketing and sales strategy? And we're going to cover more stuff next week, over the next 2 weeks, next 2 trainings at least. It'll give you more information around these different topic areas.
Awesome. Thank you so much.
Yeah.